Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I've been following his work for years. Bill Holter writes and is partnered with Jim Sinclair at the newly formed Holter-Sinclair collaboration. Prior to this, he wrote for Miles Franklin, which is a large United States bullion dealer from 2012 to 2015. Bill worked as a retail stockbroker for 23 years, including 12 as a branch manager, and he left Wall Street in 2006 because he saw the collapse coming. Thank you for joining me today, Bill.
Glad to be here, Jason.
Now, Bill, I want to talk about the inflation versus deflation debate. On the mainstream financial media and with other experts, and I'm using air quotes, like Harry Dent,
Okay.
we have people saying, deflation's rampant, commodity prices have dropped, the emerging markets are obviously in peril. But when I go to the grocery store, my healthcare bills, rent, when I look at these things, when I see the asset markets over the last X number of decades, I see, stocks, bonds, real estate, these things are all at very high valuations. So why is the mainstream media keep talking about deflation when there's obviously signs of inflation?
Well, you have to understand the central banks are caught in a trap now. They have to reflate. We've gotten to the point where there's very little collateral left to leverage against. And that's dangerous because just as in any Ponzi scheme, you always need new money to keep the game going. And that's the problem now is that there's very little collateral left. So deflation, a collapsing of asset prices is a very real risk, a very real danger. So you've got the central banks trying to reflate frantically. That's what QE1, 2, twist, and QE3 were all about, was to try to keep the stock market, keep the real estate market, keep the bond markets up, and keep them from deflating. Now, if you go to the grocery store, like you said, you're going to see inflation. The things that we need, the necessities, those are inflating.
Yeah, and we had John Malden, who's a well-known newsletter writer. He's more mainstream, though. He used to consider himself somewhat of a libertarian and used to read Austrian School Economics. I think now he's jumped off that bandwagon. But he just wrote out an article bashing John Williams, a shadow stat, saying, there is no inflation, and what we've heard with Harry Dent. But it's obvious to me that there's definitely inflation going on right now, and I think that's a great point you brought up about the central banks, that if there wasn't central bank intervention in all these markets, everything would have collapsed already. I mean, free market forces, capitalism, it's more naturally deflationary, at least gradually, right? Because people get more for less when there's more competition and higher quality goods and services at lower prices, and wages fall gradually and things like that. And after the Civil War, we know that free market forces produced beneficial deflation for Americans, but it doesn't seem that people in power want to allow that for a bunch of different reasons, any type of deflation at all in either wages or prices or anything like that.
You're right. We have natural forces of deflation, and that's because we got to a debt saturation level. So the natural forces are for deflation, whereas you have central banks. All the central banks are trying to do at this point are frantically trying to reflate. It's a tug of war, and it's a tightrope that the central banks have to walk. Now, if you look at what the Fed is doing, the Fed is going back and forth day by day. We're going to tighten. We're going to do negative interest rates. We're going to tighten. We're going to do negative interest rates. They're going back and forth and back and forth. It used to be, every 3 to 4 years you'd see them talk about changing rates, and then it was, once a year, and then it became quarterly, and then monthly, and here it is. It's basically daily. You're seeing one Fed governor come out today and say that, float a trial balloon of negative interest rates. And then the next day you have Janet Yellen coming out and saying, we might increase interest rates. I don't see any possible way they can increase interest rates because they'll smoke the financial system within 48 hours if they do that.
Yeah, I mean, they can maybe do a token interest rate like a quarter point, but then even that, a couple of those, that could, set off enormous daisy chain contagion. We have the developing markets, which took out, they leveraged to China. They built their countries' economies on exporting to China with higher commodity prices. They took out massive amount of debt in U.S. dollar denominated debt. They're hurting. So an interest rate increase on their debt would basically collapse them like subprime or worse. We have the shale oil boom, which is it's been in a bust for 12 months, but we haven't seen a massive amount of bankruptcies yet. We haven't seen the bank.
They're coming. The bankruptcies.
Yeah, we also haven't seen the banks write off the bad loans yet, but I agree. I think they're definitely coming down the line. It's just, I don't know why Wall Street still gives the Federal Reserve and these other central banks any credibility at all, because, they say, oh, now the interest rate increase is postponed till December. But how many times has this token interest rate increase been pushed back? It's countless times.
Right. Well, one thing you have to look at, again, this is it's an election year. I mean, right now we're 12 months away from the next presidential elections. And the Federal Reserve, historically, I don't believe they've ever raised interest rates going into a presidential election. I think the only time they actually lowered interest rates going into an election was in 2008, and that was because of the financial crisis. You mentioned that you think they could do a token 25 basis point rate hike, and that's it. I don't think they can even get away with that.
Yeah, I mean, it's just semantics. Even if they do it, it's not meaningful at all. The odds of interest rates even normalizing, I don't think interest rates personally can normalize ever again until the system has collapsed.
Well, let me put it this way. They cannot tighten credit. Now, what they could possibly do is raise interest rates but flood the system with more liquidity. That's a possibility. But they're definitely going to have to flood the system.
That would lead to, really bad stagflation, even worse than the stagflation we have now, or potentially hyperinflation then, if velocity of money then starts to pick up, with people start to panic, they see how much money is created or things like that.
Well, you have to remember that these fiat currencies are debt-based. So if you have a collapsing, imploding financial system, it's on one hand, it's going to look like deflation because you're going to have deflating asset prices. But on the other hand, you're also going to have currencies that are collapsing in value. So a bar of soap is a bar of soap, and it's going to cost more dollars, yen, pounds, euros, whatever, to buy that bar of soap. So we can have the worst of both worlds. We can have deflating asset prices, yet inflating things that we need. In other words, the stuff that we have that we're invested in is going down in value, but the stuff we need on a daily basis costs more. That's the worst of all worlds, and that's probably where we're headed.
Yeah, and the developing world, Bill, is already experiencing that right now. Right. A friend of mine, he's a permanent resident in Brazil. He was born in the United States. He married a Brazilian woman, and he converted dollars to real in a Brazilian bank account. It was there over a year ago, and he's had enormous devaluation. So, the mainstream financial press here in the United States is talking about deflation, right, in the emerging market and commodities prices. But talk to the people in these commodity currencies and in the developing world where their currencies have drastically devalued against the dollar. I mean, your standard of living has collapsed a lot. So it doesn't seem like that's deflation to me then, especially if you're in a currency crisis.
Right. If your currency is collapsing versus the dollar or versus especially real goods, you're experiencing inflation. You're also at the same time you're experiencing a loss of purchasing power in your financial assets.
Sounds like a double whammy to me.
Right.
Sounds like a lot similar to a stagflation, except that wages in the 1970s stagflation in the United States, wages rose and asset prices for at least for a while rose, but we're not having the exact same type of stagflation, but it seems like a stagflation type of scenario, at least in some aspects.
But there's a big difference between now and the 1970s. In the 1970s, we didn't have and I'm talking from a U.S. standpoint, we did not have a government that was basically broke, carrying funded debt of over 100% to GDP. We did not have an over-leveraged real estate market. We didn't have a stock market with high, very high PE, price-to-book ratios, and very low dividend yields. We had room back in the 1970s, and you saw it through the 1980s. We had room to leverage up. There was still collateral. There was lots of collateral that was not borrowed against. And that's what you saw happen from 1982 on, is that the system-wide was leveraged against. But now there's no collateral left to reflate again. There is no chance at a reflation again because there's no collateral left to reflate off of.
That's interesting, yeah. And Paul Volcker raised the interest rates back then. The economy actually, things were bad, but people survived. I don't think any of the economies could survive interest rate increases like that now.
Well, and we still had a manufacturing base back then. We don't have a manufacturing base today. And there's no way you can run interest rates. I mean, he ran them to 20%. You can't run interest rates to 3 or 4%. The debt will not. The debt can't be carried. The only way the debt can be carried is at 0% interest rates.
Yeah, there's too much financial engineering and too much bets on the derivatives market way above people's asset base by the banks and hedge funds and things like that, investment banks. I want to talk about gold now. Harry Dent is saying all commodities are going to fall even lower, but when I look at the cost of these gold miners, primary gold miners, primary silver miners, base metal miners that are producing silver as a byproduct, gold as a byproduct, a lot of these commodity prices have fallen a lot. These miners have very bad balance sheets. I don't see a situation where I see real strong demand globally, especially in emerging markets out of China and India for physical precious metals. I see demand increasing, especially for silver out of India when the price drops. I see supply problems for the miners with the paper price down. This market doesn't look sustainable to me. How could commodities prices fall that low and there be any type of supply, especially for a commodity like silver, where there's not an enormous hoard of above-ground stockpile?
Well, first off, the only way that could happen would be the paper price of gold go to $700 or silver go to $9 or $10. That would be the paper price. But there would be no physical transactions taking place at those levels. If you look at silver, if you look at the smash back in late 2008, you look at the smash last year and again this year when silver got down to, call it $14, none of it ever traded under call it $17, $18 because of the premium. It won't change hands. Now, Harry Dent's argument that gold is going to trade with the commodities. Gold is money. Gold is not a commodity. And his is that back in the 1930s there was an interchangeable aspect between gold. Dollars were gold and gold were dollars. You could walk into the bank with $20.67 and come out with an ounce of gold, or you could walk in with an ounce of gold and come out with $20.67. They were interchangeable. So what I'm saying is today's dollar, which is backed by nothing, is not your grandfather's dollar. And in fact, Harry says that the dollar was the best performing asset during the Depression. That's not true. The dollar was devalued from $20.67 per ounce to $35 per ounce in 1934. So
exactly.
The best performing asset was gold. The second best performing asset were dollars, and that's because they were a derivative of gold.
The gold miners were also superb performing assets too, because their costs dropped and the price of gold went up due to the devaluation, and you had the gold mining stocks after the dollar was devalued against gold, they went through the roof as well. So like homestake mining and dome mining and dividends increased.
The very, very best. The miners were, bar none, the very best, far better than gold itself, and it's because, like you said, their cost to produce were going down, and their product went up 70% in in dollar terms. So, I mean, the miners were an absolute home run throughout the Depression.
Do you think the future holds a similar fate then for the gold and silver miners, the ones who survive, where their costs are going to maybe drop for a while and the price of the metal is going to go up?
Well, I do. I think you're going to see gold revalued, silver revalued much higher. I think what you've been watching over the last 2, 3, 4 years, China has been basically gobbling up all of global production. This year, last year, they're scooping up 2,400 tons per year. And if you take out Russia and China's production, that's what the world produces. And then you've got India with 1,000 tons. You've got Russia buying, the rest of the world buying. Where has that gold come from? That gold has come from the only place it could possibly have come from, and that's Western vaults. And those are not unlimited supplies. So we're probably very close to a point where China's going to buy some gold, and they're not going to get delivered. And once they don't get delivered and realize there's no more gold for them to be had, they're going to take the bull by the horns, and they will revalue gold to levels much, much higher than they are right now.
Yeah, I think we're up to 293 ounces for every 1 ounce of real physical gold on the registered category in the COMEX. But it seems to me China wants to create a gold fix on the Shanghai Gold Exchange soon. What do you think that could potentially do then for the gold market? Do you think they would do that then after delivery of physical gold from the West stopped?
It would probably be all at the same time. You'd probably see a cleanup of COMEX. I mean, they only have 4 or 5 tons in the registered category. That's nothing. It's $200 million worth of gold. And while we're on the subject, you mentioned there's 293, quote, ounces. They're paper ounces. They're fake, non-existent ounces that have been sold, and that's what's pushed the price down. What that basically means is only one person out of 293 people are going to get their gold when they ask for delivery. There's so little gold there that probably an institution is going to come in and just buy what's left, and that's it. COMEX is done. COMEX will no longer be a pricing mechanism. Shanghai will become the pricing mechanism, and that is going to be strictly a cash market. So they will price gold once they stop. Once they don't get a delivery, the game's over. COMEX will be cleaned up, and the pricing mechanism will move to Shanghai.
Yeah, another thing, Bill, I can't figure out, and I've interviewed John Embry of Sprott. I interviewed him last year about this, is where is the physical silver coming from? Because there's even less physical silver above ground than there is gold. So the physical silver market, to me, Bill, with how much people on Main Street and retail are buying in physical silver, how much the Indians have increased their buying in physical silver, I think it's up to 10,000 ton pace on an annualized basis. I don't know where the silver is coming from that all these purchases are being bought with.
Well, first off, the real tightness that we saw over the last 2 or 3 months, 4 months, was in the silver market, not so much the gold market. So the tightness did rear its head in silver. My only guess where silver could have come from to satisfy demand, it very well could have been or could be Chinese silver, because they know that the gold outstanding, the gold in the West, is far more valuable than silver. So they may have been supplying silver, hoping to keep the game going so that they could drain the supply of gold. I mean, that's just pure speculation. I have no proof whatsoever. But what I do know is that China historically was a silver nation, and I do believe that they leased 300 million ounces back in 10, 12 years ago. They leased 300 million ounces to the West. So that very well could be where the supply has been coming from, is from China.
Yeah, I believe China was on a silver standard, obviously during many dynasties, but they were also on a silver standard prior to the Communist Revolution in 1949, right? Oh, actually, it was FDR who did it. Sorry, not 1949. It was FDR's policies of he was paying silver miners above the spot price of silver, and this was during the Great Depression, 1929, and that was draining silver out of China. The silver was leaving China and coming to the U.S. for the higher price. But the gold to silver ratio, Bill, it seems really out of whack. So maybe if
the gold to silver ratio is completely out of whack because they're mining, call it 10 ounces of silver for every 1 ounce of gold. And in reality, that's where your gold to silver ratio is going to go.
Yeah, I agree. I think, in the long term, we're going to have to get, I think, 15, 16 to 1 that a lot of people quote, that was like a government mandated gold to silver ratio. That wasn't the geology, like you said, coming out of the ground.
Right.
The geology is more like 9 or 10 to 1.
Yeah,
for
and
every
if you look longer term, and when I say longer term, call it 20 years, for all intents and purposes, unless the silver price goes into the hundreds and thousands of dollars per ounce, it will become, for all intents and purposes, an extinct element. The only way that it'll be mined is as a byproduct. There will be no primary silver producers.
Well, if prices stay low, yeah, but at a high enough price, it'll bring more silver miners online. The thing, though, is that, silver is consumed in industry. A lot of it's not recyclable unless silver is at triple digits.
Right.
Most silver is not recyclable at anywhere near these prices.
That's correct.
I want to ask you about Martin Armstrong's view on gold. He's controversial in the gold community. He's nailed the chart price of the stock market and of the gold market. He's nailed the paper price of it, but he doesn't seem to understand what's really going on in the gold market. You just put out an article recently about it. What's your opinion on his views on gold?
Well, I put 2 articles out. I put one out Monday or Tuesday, and he just absolutely denies that there's manipulation. And all you have to do is look at what we were just talking about earlier, that there's 293 paper ounces of gold versus every 1 real ounce that exists. So they've diluted the price, basically. I thought that article was enough, and one of my readers sent an article that he had written 4 or 5 weeks back that says gold is not money, and he actually came out and said that gold was devalued during the Depression. And that is absolutely false. That is absolutely not true history. It's like I titled this article, the second article, A Tool, a Fool, or Rewriting History. Because that's really what he's doing by telling people that gold was devalued. That's ridiculous. Gold was revalued. It was the dollar that was devalued. And he's doing a complete disservice to the community, a complete disservice to the public by scaring people away from gold, because it's going to be your ultimate insurance policy in a financial Armageddon.
Yeah, I've seen the old ads in the newspapers from 1933 when FDR started the confiscation, and obviously people got dollars back for their gold, but I've seen the ads in the paper saying, turn in your gold, it's a felony, you'll risk jail time and fines and things like that. That doesn't seem to me like they were planning on devaluing the metal. Obviously they're trying to prevent people from owning it, but they wanted to do what Keynes wanted to do, which is always constantly devalue the currency.
Right, they wanted to devalue the currency and a higher gold price. They were fighting deflation back then, which is somewhat what we're doing right now. And the thought was if they revalued gold higher, they could put some inflation into the system. And it actually did work somewhat from 1934 to 1937. The deflation did abate a little bit, but what ultimately got us out of deflation was World War II.
Yeah, well, FDR put a lot of wage and price controls in, and there was Smoot-Hawley, so I mean, like, it was a dystopian type of thing going on there for people who just wanted to run their businesses and stuff like that. There was a lot of embedded inflation in that system due to the wages and price control and other stuff. It created shortages, artificial shortages,
right,
and things like that.
Right.
Although I think the metals price manipulation now, it's more covert than the London gold pool. But it's kind of, de facto price control. So they have, this paper market like you set up before with the leverage ratios, and they don't even need the metal for the most part because a lot of these hedge funds that trade paper, they don't even demand delivery of the physical yet, especially in COMEX.
Right. So there's no purpose in trading it. I mean, they're trading it. They're not buying it. They're not taking it off the market.
My final question for you is, why do you think China and Russia haven't pulled the plug yet? What else do they need to do? What are maybe some of their goals in keeping the status quo going? And why haven't they pulled the plug?
That's a simple question, because China is still having gold delivered to them. It's very simple. That's not addressing Russia, but that's addressing China. As long as they can convert dollars into gold, the game will keep going. But once they don't receive delivery on gold, it's over. And you can see, if you're looking at Russia, you can see the push back and forth between Russia and the United States. So it tells me that the non-delivery, we're getting closer and closer to it because of the pushing and shoving match between the United States and Russia.
Yeah, that's very interesting. And I'm also surprised that China hasn't started buying more of these undervalued gold miners yet. Now, maybe, they in certain countries like Canada, they're not allowed to buy 100% of a Canadian gold miner. I think due to xenophobic laws, they're only allowed to buy 50% and do deals like that. But I'm surprised we haven't seen, since they have so much paper, them go out and do massive amounts of these deals.
Well, they have done and have been doing deals in Africa. But you're right.
Yeah,
as far as Canada is concerned, and I think it's a function of China does not want to be a minority shareholder in any situation.
Yeah, I realize they're doing them in Africa. I'm just surprised they haven't gone into, Latin America, North America, Canada, so many of the other continents, and just start buying them up and trading drastically overvalued paper for cheap gold and silver in the ground and oil and things like that. We've seen it to a lesser extent, but I haven't seen it on a massive scale yet. Maybe that's to come in the future.
If you go back, I think it was in 2002 or 2003, and I'm not positive, but I think it was ConocoPhillips. China wanted to buy ConocoPhillips, and they were told no on the basis of national security. That's kind of what kicked off irritation, if you will, with China, because basically they were told, you got to take these dollars, but you can't spend them.
Yeah, I think they also tried to do the same thing with Unocal 76, which owned a rare earth mine. And
you're right, it was Unocal.
Yeah.
It was not Conoco. You're correct.
Yeah, so it was oil and rare earths, and the U.S. said, no way, you're not getting both things from us. We're not letting you have any of those things.
Right.
Yeah. Now with the gold and silver ratio over 70-1 favoring for gold, do you think then that silver is more extremely undervalued and the better buy to keep accumulating at this stage?
Yeah, that's a no-brainer. The only problem is, if you got big money, if you're talking about $500,000 or $1 million or whatever, $1 million worth of silver, you're talking about lots of boxes. So the portability is the only constraint. The portability is the only thing you have to think about. But from just a pure dollars and cents standpoint, silver is the cheapest asset on the planet. It's a no-brainer compared to gold. It's a no-brainer compared to everything.
Yeah, I agree. I think silver is so undervalued right now, and we're seeing, these base metal miners that produce silver as a byproduct and these gold miners that also produce silver as a byproduct. We're seeing these guys do very large royalty and streaming deals with like Sandstorm Gold and Silver Wheaton and Franco-Nevada and Royal Gold. Some of these big four companies, they've never done a silver streaming deal before, and we're seeing them do it now because the terms, silver's so cheap that they're like, well, it can't go that much lower because then the mines are going to start shutting down.
Right, they're getting them for nothing.
Yep, and that's why I own a lot of shares of royalty and streaming companies. I think those guys they're the only ones with cash in the mining industry right now, other than the loan shark terms that private equity can give.
Right.
So the royalty and streaming companies are coming in with cash and access to cheaper capital than the miners and doing lots of deals.
You are correct.
Well, Bill, I enjoy your articles. Please tell our listeners where they can find them.
You can go to www.jsmindset. It's JSMINE set.com. It's Jim Sinclair's site. All my work is posted there, and from there it goes all over the web. There's probably close to a dozen websites that carry my work now.
I just want to tell you, keep up the great work with your articles. I enjoy your interviews on USA Watchdog, and hopefully I can have you back on again in the near future to talk about the gold and silver market.
That'd be great, Jason. I'd like to mention one other thing. We are doing Jim Sinclair, myself, and Andy Scheckman from Miles Franklin. We're doing Jim had been doing conferences up until a year and a half ago, 2 years ago, and we're going to start doing conferences again. Our first conference is going to be in Los Angeles, November 14th, and you can go to Jim's site and sign up if you'd like to come.
Great. Yeah, Jim Sinclair is Mr. Gold. For listeners not familiar with him, he helped liquidate the Hunt Brothers position, and I think he actually called when gold was at, $250, $300 an ounce. He predicted a major bull market, and people laughed at him, and he almost got the exact high in gold, I think, at one point. Although, the last couple of years haven't been as good with his predictions.
Gold in January of 1980 and sold. At the time, it was the largest gold position on COMEX, and he sold out that day. So he absolutely top-ticked gold and remained silent until, call it 2001, and became bullish again.
Well, the market's not a rational market, and there's so much intervention in it. It's confusing a lot of people. I think the manipulation in the paper price and these gold as a pet rock articles, they're designed to just break people's will.
Right, and that's what's happening. I mean, people are getting weak. People who have owned gold for years are getting weak in the knees, and now is absolutely not the time to be nervous. Now is the time to be backing the truck up and buying as much as you can, because you're buying it under the cost of production and at artificially low prices. So,
yep, it's the old Benjamin Graham or Warren Buffett or Rothschild quote. Be greedy when others are fearful, and buy when there's blood in the streets.
Right.
And I think we've gotten to the point of, as Sir John Templeton would say, the point of maximum pessimism. That gold as a pet rock article probably about put in the maximum pessimism point for sentiment.
I think you're right, Jason.
Okay, great. Well, thanks again for your time, Bill. I enjoyed this discussion, and we'll have you on again in the near future.
Thank you. I look forward to it.